Picture this for a moment. It's the kind of moment many people dream about. You're in your mid-40s, it's a quiet weekday evening, you're sitting at your kitchen table, bills spread out, a sense of calm in the air, right? One final check, a big one. That check drains your savings, it empties your emergency fund, it even uses what was left from a small inheritance. Savior. But emotionally, it feels incredible. You seal the envelope, you mail it off, and you take a deep breath. The house is paid off, no lender, no monthly payment, no debt. That night, you sleep peacefully, convinced you've just made the smartest, safest financial move of your entire life. Now, let's move the clock forward 6 months. The economy slows, your industry contracts, and your job disappears. Suddenly, there's no paycheck. You open your bank app and see the problem immediately. There's nothing there. All your available cash was sent to the bank when you paid off the house. Groceries still cost money. Utilities don't pause. Your car doesn't care that your home is debt-free when the transmission fails. You look around your house knowing there's hundreds of thousands of dollars locked inside those walls. But walls don't buy food. Equity doesn't pay mechanics. You can't swipe a brick at the checkout counter. So you go back to the bank asking for access to that equity. And they say no. No income, no loan. You're sitting on enormous wealth, and yet you're financially stuck. This is the liquidity trap. By obsessing over eliminating debt, you didn't create safety. You created fragility. You traded flexibility for a psychological badge of honor. And in the process, you sacrificed long-term wealth and short-term security at the same time. The belief that paying off a mortgage early is always responsible is deeply emotional, not mathematical. That belief comes from a different era. Decades ago, when interest rates were painfully high, eliminating debt really was survival. If your mortgage charged double-digit interest, paying it off delivered a guaranteed, unbeatable return. But that world no longer exists. Today, many homeowners are locked into mortgages with rates that are historically low. And when you aggressively pay those down, what you're actually doing is choosing a very low return on your money. Mortgage payments don't earn you freedom. They earn you the interest rate you're avoiding. If your rate is 3, 4, or even 5%, that's the return you're getting. Ask yourself this honestly. Would you willingly lock your savings into an account that pays 3%, can't be accessed easily, and penalizes you during emergencies? You're of course not. Yet that's exactly what aggressive mortgage payoff does. At the same time, long-term investing has historically produced far higher returns. Choosing to pay off low-interest debt early often means choosing comfort over compounding. That difference doesn't feel dramatic in year one, but over decades, it becomes enormous. This is where the concept of financial spread matters. Banks thrive by borrowing money cheaply and lending it out at higher rates. The difference between those rates is how they make money. Individuals can do the same thing. If your mortgage costs you 4% and your investments can reasonably grow at 7 or 8% over time, that gap belongs to you. That gap compounds. Remove the debt early and you eliminate the spread. You shut down one of the most powerful wealth-building mechanisms available. Instead of letting leverage work quietly in the background, you choose to operate without it, and you pay the price in lost growth behavior. Now, many people hear this and immediately think, but debt is dangerous. The problem is how risk is being defined. Most people believe risk means owing money. Behavior. In reality, risk is lacking access to money. When extra cash is sent to a mortgage lender, it becomes illiquid. It's locked away. It can't help you during a crisis unless someone agrees to lend it back to you. Lenders are least cooperative when you need them most. Liquidity is what creates resilience. Someone with a mortgage and significant liquid assets has options. It is weather, job losses, and adapt. Someone with a paid-off house but no cash has only shelter, not flexibility. Even property ownership doesn't eliminate obligations. Taxes still exist. Maintenance still costs money. A house without liquidity behind it is not the fortress people imagine. Inflation makes this even more important. A fixed-rate mortgage quietly shrinks over time. The payment stays the same, but the value of money declines. What feels expensive today becomes manageable tomorrow. Eventually, it becomes trivial. When you pay a mortgage early, you're giving the bank strong dollars instead of weaker future dollars. You erase one of the most powerful invisible advantages borrowers have. Time and inflation were working in your favor, and you stopped them. There's also a massive opportunity cost most people never see. Extra payments feel productive, but they often replace long-term investing. Month after month, money that could have been compounding elsewhere is quietly absorbed into home equity. Years later, the difference shows up as a smaller portfolio, fewer options, and slower financial independence. Even worse, many people don't actually invest aggressively after the mortgage is gone. Lifestyle expands. Spending fills the gap. The discipline they thought would arrive later never does. True financial strength isn't about eliminating every liability. It's about control. It's about having assets that can support obligations without surrendering ownership. When investments generate enough income to comfortably cover expenses, including housing, debt becomes neutralized without being erased. That's leverage working for you instead of against you. There are exceptions. High-interest mortgages, paying them down makes sense. Lack of financial discipline, forced payments may help, but for disciplined individuals with low-interest loans, rushing to zero debt often destroys one of the most valuable financial tools they possess. Debt isn't morality. It's mechanics, and mechanics don't care how something feels, only how it functions. So here's the practical takeaway. If you're sending extra money to your lender every month, consider redirecting it. Put it somewhere liquid. Invest it deliberately. Track the results. Over time, compare what you gained versus what you would have saved. The difference will speak louder than any opinion ever could. A paid-off house may look impressive, but liquidity, flexibility, and compounding power are what actually protect you. Security doesn't come from erasing numbers on a statement. It comes from having options when life stops following the plan.